Our panel discussion will focus on WealthTech, which is the latest sub-vertical of Fintech, focused on asset management, on wealth management, private banking, and how technology changes both the front office, the client engagement, and also the back office operationally. So how the whole value chain is being reinvented to some extent. And I wanted to introduce you to our panel. In a second, we've got a very, very spectacular panel members chosen to talk to you today about each of those very important trends. But before that, let's introduce each of you. So maybe if I just start out with myself, my name is Susanne Chishti. I'm the CEO of Fintech Circle. Fintech Circle is a global community of fintech investors. So we invest in early stage fintech companies, normally up to £500,000. So it's really the first time companies look to raise money. We also advise banks on their acceleration programs, enterprise innovation methodologies. And the third thing what we do is education. At education, we publish books, and we just launched last month a book on WealthTech. It's called the WealthTech book. It's published by Wiley, and it's the first crowdsourced book on this subject. So anybody who wants to read more about it, please feel free to get a copy of our book. Our first book, the Fintech book, became a global bestseller. This was launched 2 years ago, but last month we launched the WealthTech book. So that's a little bit about me. So if I hand over to you, please, Angus.
Thank you. Angus McFadyen. I'm a technology lawyer and partner at Pinsent Masons. My day-to-day is working both with financial institutions through all the way to startups, helping them embed new technology in their business, launch new products, and also embed the partnerships between the institutions and those startups, either, say, collaboration-type partnerships or investment-based partnerships.
Morning, everyone. My name is Hemal, Mehta, and I'm the founder and CEO of AtomInvest. We are Europe's first platform that provides access to top-quality private equity, venture capital, and hedge funds to individual investors as well as small institutional investors. Why is this important? It's because what we do is we enable our clients to build their wealth through investments that deliver much higher returns than traditional asset classes, but today are completely inaccessible to the average investor.
Good morning, everyone. My name is Sebastian Verkuilen, founder and CIO of Check6. Check6 is a company providing fully automated, fully anonymized data aggregation for clients in order to enable them to gain full control on their wealth. We work with single-family offices, multi-family offices, and private banks on the matter of data aggregation in order to provide them with client solutions such as integrated investment reporting, compliance reporting, and third-party data platform integration.
Hello, everybody. Good morning. My name is Theo. I'm CEO and co-founder of Wealthify. We are democratizing investing, trying to make investing something that anybody could do, make it accessible to everyone. You can invest with Wealthify with just £1, and that's our way of letting anybody try and get their first foot on the ladder of making a better return from their money than having their money locked away in savings. I've also recently taken on a part-time role for the UK government as the Fintech Envoy for Wales. It's part of the UK government's Fintech strategy, which is recognised that actually 80% of Fintech businesses are still in London today, and actually there's no good reason why they couldn't be in a range of other places in the UK, including where I live in Wales.
Excellent. So that's fantastic. Thanks very much, Richard. What we want to do first is to give you a helicopter view on how the industry is moving forward. I remember I worked 15 years ago for Morgan Stanley Asset Management, 7 years, both here in London and also in Hong Kong. And we were all an active fund management house, with billions of AUM globally. And at that time already, there was lots of criticism, for asset management, that we are non-transparent as an industry, we charge too high fees, and we don't service our customers necessarily in the best possible way. So what has changed? Has anything changed? What are the trends which all of you see? So maybe if we start with you, Richard, now.
Okay. So at Wealthify, we've sort of done the first part of the wealth tech journey on a direct-to-consumer basis. So we've simplified the way that people can get access to investing. So rather than getting that first step on the ladder as a DIY investor and picking stocks, which is a really bad idea, we do that job for you of picking and creating you a diversified investment fund. The sort of main topic that goes on in the direct-consumer space really is about the digitization of financial advice. And it almost feels like we're all being sort of pulled with a sort of nose ring in saying, you've got to do online financial advice. But today we at Wealthify have kind of stood back from that because we recognise that there's a class of customer out there that isn't actually looking for financial advice. They just want a better return on a proportion of their money and they're happy to make that decision for themselves. But we, like others, spend a lot of time looking at, well, what would it take to actually do real digital online advice, but do a full job of it. It's no good just taking financial advice to mean, well, am I putting my money in an ISA or a GIA or a SIP? Financial advice, the kind of financial advice that our research tells us people want, is the full package financial advice. So where should they invest their money? How much should they save? What are their goals in their life stage? How are they planning for retirement? What protection products do they have to protect their family from the events like one of the family members dying and things like that? So we think that's a good few years away from digital solutions being able to offer that in a way that you, the consumer, would trust enough that you really go through. Of course, part of that conversation is also about how can AI, artificial intelligence and machine learning play in to solve that problem. And I think there's a lot of thought got to be put to that because everything in our market is about trust. Do people trust the proposition? And I challenge you with the question, if your financial advice, your whole of your financial world was based on advice from a robot, artificial intelligence, we've got to go a long way before you will have the confidence to trust that and put your money behind it. So the battleground is there, but I'm sure we will get there in the end, and everyone's thinking about ways to do that.
So in terms of AI, just a follow-up question, Richard, where are you in this debate? Do you think that the financial advisor, the human being is superior? Do you think the robot is superior? Is it a combination of both? What's the best option?
Yeah, well, I mean, today there is no substitute for human advice because the kind of questions that you need to ask a client in the financial advice world are really, really subjective. So, the first question you ask will lead to a whole different range of second, third and fourth questions, depending on the replies. And the replies can be really off the wall and random. I'm saving towards going on a cruise around the world. I worry about my retirement. I worry about my children and their health. So it's very difficult to kind of automate all of that in a consistent and reliable and effective way that will solve everyone's problem. So, today a lot of the robo-advice, the online or the digital investment solutions are sort of looking at actual human hybrids. So there are services out there doing online digital investing, but offering you a human via chat or via the telephone or via face-to-face to give you that full advice. And those two are so far apart. It's at what point do they meet in the middle and join up, and that's a good way off.
Yes, I agree. So it's normally still human-robot hybrid, hybrid models, I think, which lead at the moment, most platforms. If you go, Sebastian, to you, when you look at the big picture, WealthTech, which trends do you see and which are most important for you?
Yeah, in addition to what Richard said, I think there's a true revolution now within wealth management where advisors can't go without a strong digital offering for their clients. And a strong digital offering, like, for example, robo-advice, like AI, must be fueled. And the fuel to give this advice is data. And data empowers the financial advisor to bring the advice to the next level. And with that, the client will in the end have the ownership of the data and determine who has access to this data and in what form. And also what you just said and what Richard just said, I don't believe that the robo will replace the human. Also studies show that 84% of the people still want to have a financial advisor. Not for the number crunching, not for the data, but purely for the guidance. As you said, subjective questions will always be there and the financial advisor must give the guidance, but based on the availability of a lot of data, and the crunching is already being done.
Yes, great. So data is the new oil, huh? People always say
I would say
that.
so.
Yes, that's excellent. And Hemal, for you, what are your trends?
Sure. Thanks, Susanne. The big trend I see, or we see as AtomInvest in the WealthTech space, is the democratization of investment in asset classes. What we've done is we've fundamentally looked at wealth management and thought that what's the most important thing in wealth management? It's about making clients money, and making clients more money than everyone else. And looking at it that way, and also to Richard's point, is that a lot of people have money in their savings accounts. And what we've done is we've just looked at the mathematics of people putting money into their savings account. So if they left £100,000 in their savings account for the next 25 years at 0.5%, they'd end up with £110,000. It's not great. If you put it at 5%, so that's maybe stocks and bonds, real estate, you'd end up with £300,000. You'd end up with 3 times your money in 25 years. Now, if you invested that money at 15%, you'd end up with £3 million. You'd get 30 times your money. Now, looking at it that way, we've kind of worked backwards into thinking that how do you get those investments that on a consistent basis would return 15% per annum for the next 25 years? And looking at it that way, we found that there's certain asset classes today that are not accessible to most high net worth investors, or even most investors, broadly speaking, to enable them to grow their wealth. And that's why we think that opening up access to these asset classes or these type of investments, such as private equity, venture capital, hedge funds, in a secure and easy way is quite important in terms of making wealth or the access to wealth open to everyone.
Excellent. So 3 entrepreneurs, you heard their views. And now if I can ask you, Angus, because Angus is a tech lawyer, of course, sees the whole industry very well, top down. So which trends do you spot from your perspective?
I'd probably split it in 3 different camps. Firstly, the sorting out the back office, improving efficiency, quality, driving cost out of the back office. That's something that's taken a while to get hold, people really investing in their platforms at the institutional level, but that's now happening and not as quickly, I think, as it should do, but is coming along. The second one is sticking tech and wrapping it around existing products, skinning them slightly differently, giving them slightly different routes to market. There's a lot of activity in that space, but it's not always the most exciting stuff. And then the last one is new tech, mass disruption, new product offerings. So that is really solving the advice gap. That could be actually fixing the UK's house buying and selling process, bringing open data to the whole financial services world. And that's one that we're at a lot of activity in that space with open banking, all the debate about pensions dashboard, when's that going to come into reality? But I'd actually prefer us to stop talking about open banking and pensions dashboard and have totally open financial services so that the retail investors can really control everything and see everything, pull it into their advice service. Because right now we're doing things in too much of a siloed way. So there are a lot of different trends if you put those different buckets, but for me, the first one about sorting out the back office and the mass disruption, the third one, are the most exciting areas.
That's excellent, Angus. I remember when many of you probably have got your own asset allocation models. And I remember, when we did it in our asset management house, we had normally at the core, we had ETFs, was passive investing. Then we had satellites, which was private equity, it was hedge fund, which was supposed to generate higher alpha, higher returns, at higher risk, of course. But you wanted to have a balanced, balanced asset allocation model. And of course, you could, as high net worth investors, which both of your companies service, there are lots of non-financial assets, such as art, commodities, property, which also can be added. And Sebastian, your company, Check6, focuses on aggregation multi-custodians for your customer to see and display your customers in a visual form, all their assets. And I can only imagine how complex this must have been to put this in place. So can you tell us about the challenges you faced and how you overcame them?
Yes, the big challenge if you work with banks and with other feeds for non-bankable assets is that literally every of the 50 banks we have connected to our platform has a different method, has a different way of delivering the data, and with all the legal and compliance in place, it's not that easy to change that. So we had to build our platform that we were flexible and that the banks could provide us with the data the way they want it and the frequency they want to. For the non-financial assets, it's a little bit easier because there you can determine your own platform or API or upload the client can adhere to in your platform. So normally it was thought that financial asset is the easiest one to add to your platform, but in practice it's it's basically the non-financial assets.
Yes, and how do you value those? You know, which are illiquid, how do you value them for your visualization?
Yeah, if we have different models in place for the listed securities, it's quite easy. You have independent data providers pricing the securities. Custom securities, like for example your securities, they are priced by the private equity firms, and then you have the real estate, the own companies. Some clients choose to reevaluate the company or real estate every year. We use industry standard multiples, or some clients say we do it very simple. We just take the book value and that's it.
Perfect, wonderful. And for you, Richard, I mean, Richard started 4 years ago, Wealthify. You know, I'm sure there are lots of entrepreneurs here who just start their companies. And Richard started the journey 4 years ago as CEO of Wealthify, built up the company very successfully, and last year sold the majority to Aviva. So I think first of all you have to tell us how you did that, because lots of people would love an exit, you know, a partial exit, I guess, such as this. But also, how does this partnership with Aviva benefit both Wealthify and also your customers?
Yeah, thanks. It's a really interesting question. It's sort of breaking new ground, I think, a little bit in fintech. Wealthify, just a 4-year-old company, but what we've managed to do is demonstrate that we could really simplify our process and strip the cost out of it, and come up with a solution that really appeals to the young generation. Now, to Aviva, which is a 363-year-old UK financial institution, their challenge is that their customers are aging every year. I think their average customer is in the 50s to 60s. So they really want their propositions to appeal to the younger generation. So we appealed to them in that we brought that kind of youth, that appeal to the millennial market to them. And we appealed to them because corporates, find it really hard to simplify propositions. Propositions just get more and more complicated and convoluted. So they've managed to plug us in on aviva.co.uk, so to sort of public-facing new customers, and on MyAviva, which is their portal for existing customers. And we're bringing, simple investing, as we've now jointly called the Wealthify service, under our own brand to all of their customers. So for us, the reason we did that transaction, which is unusual, normally people would look to us and say Series A, raise money for a minority of your business. We did that because it gave us access to 15 million of their UK customers. And I think other competitors in our space are very jealous of that, because the big battle is breaking the inertia of people being stuck in savings and actually succeeding in acquiring customers is a huge challenge. So although we had to perhaps give up more of our business than we would have wanted to, it ticked that box for us in multiples. And we've managed to sort of negotiate and retain a sort of huge degree of independence so that we can go on and grow our brand, our business, based still in Cardiff. So hopefully you can see there the synergies for both sides.
And are the customers which come from Aviva, is the profile different to the customers which you onboarded yourself?
It's very early days, so our investment completed in February. Then we went through sort of completing a significant piece of technical work to integrate with the Aviva machine, and they're rolling out different sort of different platforms and different parts of their ecosystem. So it's really the first customers starting to flow through now. And yes, I mean the Aviva customers are typically older customers, as we would have expected.
Yes, excellent. Well done. Well done,
yeah,
Richard.
You, yes.
I think it's fantastic. Hemal, coming to you. Hemal looks after AtomInvest. And AtomInvest, as you said initially, is about making it more democratic, giving access to highly in demand asset classes, alternative investments, hedge funds, private equity, to those investors maybe who had not enough choice before. And so can you tell us more how it works, as a sophisticated investor, when you come to your platform, how you build up this double-sided platform, and how you provide this choice of sophisticated private equity funds, which normally you couldn't get access to unless you had 10 million to invest, to somebody who's just 100,000 pounds to invest now.
Absolutely. So what we've done is we've built a two-sided marketplace at AtomInvest, where we pick 20 high-quality private equity, venture capital, and hedge funds every year, and we make them available to our client base. who are a combination of high net worth investors and people who can say that they understand private equity type or hedge fund type investments. What we do is we partner with the fund managers, and we find the fund managers that have a really good track record. Some of the managers we work with are global, top quality global private equity or hedge fund names, and we enable our clients to participate in the returns that these funds generate. The challenge we've faced in building out our business is not on the supply side. There's a lot of high quality funds available that are open to investment from smaller investors. The big challenge is actually, as Richard highlighted, inertia, number one, because people, even though they have money to invest, they'd rather not do anything about it than pick an asset class that may generate them 5 or 6 times higher returns than they've been getting for the last couple of years. That's the first big challenge, and the second one is investor education. People don't know a lot about alternative assets. It's not an asset class that's out in the public limelight. People don't know the kind of returns private equity generate, what kind of transactions they do. Unless you're in the financial industry, you don't even know what private equity is. So what we've done to overcome that challenge, and what we're doing today, is a huge amount of investor education and keeping it simple. So breaking it down to first principles and enabling people to understand what it entails to invest into alternative assets and how it can benefit them in terms of achieving their long-term goals if they invest in some of these asset classes.
Excellent. So AtomInvest.
Yeah.
Fantastic, Hemal. And last but not least, Angus, as a tech lawyer, when I thought, what's most relevant, Angus, from your perspective, for what are the tips, I guess, you could give to those entrepreneurs in the audience, who want maybe an exit, such as Richard, a partial exit or a full exit. What are the things, maybe the top 3 tips you could give as a lawyer? What are the things to do right or what you should avoid at all costs?
Okay. Focus on your assets. So that includes things like your shareholdings and your IP. Focus on the assets and keep it simple. So with shareholdings, don't go creating complicated preference structures. Be very careful about granting rights and options to people who join your team. If you're going to do it, document it. And otherwise, when you come to an exit, you're not going to be sure about who you've got to involve. Your investors might get spooked. If they're not comfortable, they're going to be really getting a secure hold in your company. Make sure that you document your IP ownership, and don't let another co-founder leave without making sure you've got all their IP wrapped into the business, that kind of thing. So tip 1, keep it simple. Tip 2, get it documented and keep your documents in one place if you can. So if you're heading for an investment round, you're going to get people doing a load of DD on your business. If you have put a little bit of effort into pooling all your key documents in a single place as you've worked on your business and as it's developed, that's going to be so much simpler than you having to spend days of your life going off and trying to pull it out from archives, trying to get in contact with people who you think might have a copy of something important. So put it all in one place. And finally, if you're getting a partnership or an investment with a corporate, be prepared for a bit of a journey with them. It's not going to be easy. They're going to be unsure about your business. They're not necessarily experienced. Yeah. They're not necessarily experienced in your business or in investing, but they're going to be very enthusiastic. So it might take some time. Bear with them. All the comments we had from the first panel today, I absolutely agree with. It will take them a while, and they might be a bit scared too. So go on the journey.
Yes, so valuable tips which can save you millions at the exit. That's kind of our experience within Fintech circling the portfolio companies we look after. So very, very important to keep those legal tips in mind. So with that, I want to thank all of you for joining me today at the panel. Thank you all for being a fantastic audience. And thanks for joining us.
Thank you.